Welcome to today's webinar, Strategies for Effective Loan Workouts. John Winick's the host, John, Clark Street Capital. John, you have an all-star panel. We love doing your webinars. You focus on high-level macro issues, specifically for bank C-suite. You have these loan portfolios and how you should manage them. So I'm really looking forward to today's information. Hey, but I wanted to say, we ran a report this morning, something called accelerated ban. Now, what John does, he's an expert in working with lenders on buying and selling loan portfolios. John, you announced a new platform. What's that all about? Then I'm going to let you introduce the panel.
Yeah, I mean, accelerated ban is a way to keep a competitive process and still sell loans in a shorter time frame. Sometimes banks get to, March 10th or so in a quarter, and they want to move some loans at the end of the quarter. Maybe they have some money to charge off budget. And this is a way to still run a competitive process and market and successfully close a loan sale in as little as 2 weeks. So we're very excited. We did our first beta test at the end of the year and working on a number of opportunities.
John, just overall, I assume you and I haven't talked about this, but I like your input on it. How sophisticated are banks today than they were, say, 10 years ago on managing their loan portfolios for both selling them and acquiring them?
I think the financial crisis created a lot of awareness in the secondary market for all loans, both the sales of performing loans at par or better, as well as the sales of distressed and quasi-distressed portfolios.
Well, very good.
Well, thanks, Bob.
Yeah, I was going to say I'm gonna log off. You have a lot of content, so I'm going to quit talking. I'm going to let you introduce your panel and take it away, John.
Thank you. Well, it's very hard to get workout people to talk. Credit people aren't easy. Lenders are pretty easy, but to get 3 outstanding workout professionals to volunteer their time is a real treat. We've got Bill Krueger of Truist Bank, Justin Barr of Carter Bank and Trust, and Jason Alpert, formerly of Wells and now at Castlebar Holdings. With that, I'm going to turn it over to Jason for our initial presentation. Jason?
Thank you, John, and good afternoon, everybody. Good morning from where you are. It's our pleasure to walk through kind of a workout 101 and talk about some strategies and being effective with your loan workouts. As everyone can kind of read in the paper, even though some of the news is getting a little bit better, debatable, there's a really high premium for understanding and all the challenges that go through a workout scenario. So we have a little bit of a deck here. It's more to just kind of level set and just kind of set the table, and we'll have this be more of an open presentation, hopefully ask questions where we can really dive into different strategies and war stories and our take on what we see in kind of our world in our industry. I'll probably speak for all of the panelists today that the opinions that you're going to hear are our own. Not reflective of any institution or banks that we work for or previously worked for. So with that, we can go to our first slide, which is, why do loans go into our workout group? Where do these loan failures come from? And it's really about 4 or 5 different factors. The big one is your macroeconomic recessionary cycles that tend to impact loans, or like a force majeure, where a hurricane might go through, or there's wildfires that shut down businesses in a locale that can create, your problem loans. But, macroeconomic factors, business cycle issues, especially if you're consumer facing, and those type of things can result in some problem loans and inflows into your portfolios. We saw this with COVID, definitely saw it with the great financial crisis, and we may see it here with the problems that banks are challenges with CRE. Faulty underwriting is another reason that loans go into default, and it's really the failure to adhere to the basic 5 C's of credit that we all learned about when we were going through our bank training, or starting out our career as lenders and credit officers. character, not lending to the right people or the right organization, capacity or the cash flow of a business, not understanding what the revenue drivers are, how the cash is flowing through the business, not understanding what's going on there. Lending to a firm that doesn't have enough capital, their balance sheets are off, over leveraged, or can quickly become over leveraged, and things like that. Taking the wrong collateral, or taking collateral that's not perfected, or some type of issue with your collateral. And then finally, the conditions of the loan. Did we put in the wrong covenants? Did we put in any covenants? Is it lightly monitored? Something along those lines. Another reason for loan failures is the lack of due diligence. Typically, it's a failure to understand the underlying business model and the primary source of repayment. Kind of tying back into the faulty underwriting, but maybe even more so. Maybe an institution, wanted to get aggressive and go into a new market to compete, and they just didn't have the knowledge and expertise institutionally to get through that. And then finally, poor execution, weak documentation or bad legal advice, the failure to properly book and monitor and service that loan through the duration of the credit. And I'll kind of just pause right here and just make a qualification that when loans do come into our workout group, for whatever number of these factors, and I feel comfortable speaking for Bill and Justin, we're not here to Monday morning quarterback what happened with these issues. It's, it is what it is. We're here to help fix that problem. So again, this is not a finger pointing game. We want to understand the facts and the best way to get a resolution for there.
And Jason, I think that's an important point. As we all know, one of the most important things with respect to effective loan workouts is having a good working relationship with the line. And if you have a culture where you're pointing fingers and there are recriminations, that you're not going to have that good relationship.
And we can move on to the next slide. So just some early warning signs. I always like to go through and just remind our bankers and credit officer that
sounds like Jason's frozen.
Yeah, I think Jason got frozen for a minute. Justin, you want to touch on the early warning signs?
Yeah, sure. I'd be happy to, John. Well, some of these are obvious, of course. Missed or late payments, overdrafts. We can just go down this list. One of the keys, though, to identify these early warning signs is to have, good monitoring and administration of commercial credits, so that you pick up, for example, things like lawsuits or liens being filed. That's certainly key, as I'm sure Bill would agree. Bill, anything you want to add here with respect to early warning signs?
Yeah, I think the biggest thing is, when you talk about failure to meet financial covenants, it's what's the reason for it? Is this a trend? Is it a one-off item? Is it if we set at the end of the day, when we set these deals at the beginning, we all come up with what we believe is the performance. If the question is it a short-term issue, or is it a shift downward permanently? Because now you're looking at a completely different situation, and the last thing you want to be doing as a lender is going back to, we used to call them Miss America covenants, where you wave to them every quarter and just continue people that you need to get into a situation where you understand the company and you're addressing the issues, because you're not helping the company and you're not helping your institution.
Yeah.
Well, Bill, you bring up a good point, of course, and then there's the issue with respect to covenants. Are the covenants set at appropriate levels? And boy, things have been awfully frothy for a long time, or were, and you run into problems where covenants are set so loosely that by the time they trip, it's not an early warning sign. Things are really serious. So there's certainly that issue as well.
The other thing is has the business changed, or has what we thought was going to happen morphed to the potential acquisition, various other things that could happen, and are they the appropriate covenants? Just because the company's blowing through covenants doesn't mean that you've got a problem, or it could mean you have a big problem, but are they the right covenants? And a lot of times you need folks from your workout world just to look at those, because it's a fresh set of eyes, no good or bad feelings toward it, but to really ask the question, do you have the right covenants to monitor this loan properly given what the anticipated performance is?
And you go forward slide.
I think that's another example too, Bill, of the importance of having good relations between the line lending units and workout, so that if a problem is developing, the line feels comfortable reaching out, bringing in workout on a consultative basis.
Yeah, Bill, this was one of your sayings. First rule of workout: do no harm. Maybe you could expand on that.
Yeah, I think we as a teammate in any institution sometimes get a bad rep if you don't know us. For the record, we are not 8-foot ogres with spiked claws. We are more business people than credit people, and the reason I say that is the credit decision in a difficult situation is easy. No. Unfortunately, when we've already made the loan, you're really making business decisions, not credit decisions. While we're trying to improve the situation for the bank, it's always a business decision because the money's already out the door. And the first rule of that is, don't make the situation worse. Review everything. Make sure that if there's an error that you find, use this opportunity to fix it. Don't simply say, client A has been with the bank for 30 years. We need to keep them forever. Or client B is a new client that hasn't worked out. We need to move them out of the bank. It's an individual case by case assessment, and that's where I believe the folks in your workout groups, again, don't have good, bad, or indifferent any feeling about the particular client when they first see him. It's their first introduction to him, and I can tell you from my experience, I've had people they wanted to exit where I've said, why? And I've had people they insist are the greatest clients ever where I've said, run for the hills. It's just, you need people without any history on these when you come into a challenging situation to be able to give you a clean perspective. And that's, I think, what we in the restructuring world tend to do, as opposed to have any baggage and frustration given the fact that the transaction we advocated for or approved hasn't worked out as agreed.
Bill, I think that's very well said, that we're making business decisions and not credit decisions. I'd never heard it put quite that way, but I like that. I'm going to borrow that.
I stole it from somebody else.
Anna, could you go forward a slide? Jason is back with us. You're on mute. Take your mute off.
Yeah, I'm back, and I apologize for that. I don't know why it just booted me out or I froze. So getting to Bill's point about do no harm, the concept of lender liability is, top of mind for us workout folks. Certainly, we don't want to make a bad situation worse. And I definitely got this formula from a law firm that did a workout 101 presentation back when I was a baby workout lender. And since we're bankers, we kind of like formulas and math. So loan plus duty times breach equals a lender liability issue. And so basically that breaks down to a loan, which could be any type, revolving line of credit, borrowing base, ABL structure, CRE term loan, whatever it is, where you're the creditor and you've lent money, plus duty, the duties that the bank has to the borrower, either through the contracts, through the loan documents, in common law, based on, working with your customers or what's required by the regulators, as well as statutorily, times breach, which is either the act that we did something wrong or we omitted something that we should have done and we didn't, will equal the liability, which is, the damages that will be awarded to our customer that we'll have to pay over and above the loss that we'll suffer on the loan. So that could be compensatory or punitive or regulatory sanctions. Like anything, we don't want to exacerbate the situation. If there are some, lender liability issues, like let's say, and I've seen this before, new loan officer promises a borrower, something outside of the loan agreement. Hey, I'm going to renew your loan for 5 years at 2% fixed, and I'm going to release you as the main guarantor, something outrageous. We need to mitigate that. And it's, sometimes it's giving that deal and having to live up to it. It's, renegotiate, trying to negotiate around that, fall back on any language that kind of covers us. But, again, we don't want to, exacerbate the situation or make the customer angry, or file litigation right away. That, you can't, as Bill said, unexplode a bomb. Be mindful, of course, of dealing with the borrower. What basically that states is your actions speak louder than words, and the words are what's clearly stated in your loan documents. The example I always give for this one is you have a loan covenant in your loan agreement, debt service coverage ratio of 1.25. The borrower has never met it for the last 3 years, and then the credit team has had deal fatigue with this customer. They want to send it to work out. They want to exit it out. But now, lo and behold, we basically can't enforce that debt service coverage. Basically, because we've waived it over and over again, the borrower has a pretty good argument that they needed to rely upon that because we never required it. So always document defaults and reservation of rights and all that stuff. And be extremely careful when acting as a customer advocate or a trusted advisor. We do want to, help our customers, as an institution. But we certainly, don't want to give them business advice or require them to do certain actions, or else we're going to take some kind of punitive measure against that. That can get us into big trouble.
If I may
Yeah.
add, one thing that can be helpful in this area, in my experience, is bringing in a financial advisor or even a CRO.
Yeah, when you do recommend a CRO or a turnaround advisor, give the borrower a couple of names and let them choose one representative. Yeah,
always.
But they'll work with the customer, with the customer to help solve this problem in management. Yeah,
that's right. You can get where you want to go without stepping over that lender liability line or stepping too close to it.
There's a lot on this triage slide. I'm not going to go through it all, but basically, once a loan is downgraded and sent to workout, there's a clear handoff that needs to be done with the borrower, notifying them that the workout officer is their only point of contact with the bank. We don't want the customer going back to, their former relationship manager or the market president or whoever, and having two different people at the bank, trying to manage a loan. Always try to meet with the former banker and the credit team to understand the history. We want to get all the correspondence to make sure there's no quote unquote smoking guns. All the credit file stuff, any emails where there was terms and, renewal terms or anything else that was done. We want to make sure we have that because, we don't want to be surprised in a discovery scenario. With tough conversations, and I think this goes with the line, but certainly with workout, best to keep minutes of that conversation, follow up with an email to get, the what was said kind of in writing and on record. And if it's really going to be a tough conversation, bring a second, person there with you. So, it's not a he said, she said,
Yeah, we got a comment from someone, which I thought was appropriate to this conversation. We need to avoid situations of lender preference when we inadvertently establish a course of dealing in the lending relationship by continually waiving a loan covenant year over year, which we may need to enforce later on down the road. Thoughts on that?
Yeah, at the end of the day, when it comes to you have a covenant default, it's one thing to follow up with a reservation of rights letters, which kind of puts a stake in the ground. but it needs to be resolved one way or the other by the next reporting period. And if that is doing a modification or a forbearance agreement, sending 6 reservation of rights letters is the same thing as a course of dealing. It doesn't accomplish what you're trying to do. So if you go past one reporting period, they could be a default for, as Jason said, multiple years. Simply sending reservation of rights letters doesn't accomplish what you're trying to do. You need to get to a document, and whether that's a forbearance agreement or an amendment or an extension, however you choose to do it, but you need to come up with a legal amendment to the underlying agreement to ensure the enforceability of the loan documents.
Let's
And I
do
think
one
I would
more.
add,
Go ahead.
I would add, John, that there's a significant element of psychology as well to loan workout negotiations. The bank never holds all the cards, and it's a business of compromise, essentially. And in many cases, an effective loan workout is determined by your ability to garner the trust of the borrower in a tough situation where they don't want to trust you necessarily.
Yeah. Let's just do one more slide, Anna. Pull up the last one, then we'll go to the poll question, the prognosis part. Jason, why don't you take us away on the prognosis?
So once you get your entire credit file, you've interviewed, the banker, you've met the customer, you want to determine what the strengths and weaknesses are of your position. Do we have a potential lender liability claim? Do we have a course of dealing issue? That's a sign of, that's a weak position, negotiating position. And you want to clean those kind of things up. Same thing if we go through the credit file or you get a loan doc review from your outside counsel. If you don't have a perfected mortgage or the UCC lapse, you need to clean up those things first and foremost before you start, really trying to do a full-blown restructure. You want to, get that stuff clean. As someone once told me, you want to walk through quicksand and run on concrete. And if you have a poor position, you don't want to make it worse and find yourself in that poor position and sinking in the mire. Re-underwrite the credit, so obtain current financials as soon as possible. I always stress to our customer, our debtors that transparency is paramount. If we don't have transparency from you, there's not much I could do to really help resolve your situation. I need to be able to report and document why we're taking certain actions so we can make proper business decisions. And if they want to close up and they don't want to talk to you, then there's not going to be much I can do to help resolve something on a mutually agreeable basis. And then,
Jason, if I may jump in.
Yeah.
If I may jump in, you're absolutely right. The re-underwriting of the credit is so important. And, it's where the importance of credit analytical acumen really comes in. If you have a thorough analysis of the deal, it's going to lead to better decision-making. And, that initial decision-making, strategically, tactically, is of such critical importance.
Great. Yeah. Go ahead, Jason.
No, I was just going to say, at the end of the day, then make the determination if this is an exit or retained relationship with the bank. You want to make that decision with your management team. And that designation is fluid. It can come in as an exit and then it can turn into a retain, or it can come in as a retain and you move it to an exit. But that'll help, drive what our ultimate strategy and goals will be with the relationship. So
it can be tough to change tack, though. So critically important to make that determination accurately at the outset.
Yeah. We have a poll question. Let's tee it up. The poll question is, while it gets teed up, is your organization currently adequately staffed for current and expected loans and workout for 2024? Yes, no, or unsure?
I'm going to say yes, but you never know. You never know.
Panelists are not allowed to vote. Interesting. Most people are saying yes. It's our macro view that you're probably going to see a doubling of workout assets this year. So, I would suspect that some banks will need to staff up, depending on what comes in. But yeah, vast majority say they are adequately staffed. Talking about the prudent commercial workout guidance. So we had this guidance. It was rolled out in July by all agencies. In my view, it didn't differ materially from prior guidance. But thoughts, gentlemen, on the prudent commercial workout guidance?
I don't think there was much. Yeah, I agree with you, John. There wasn't much of a difference between the initial guidance that came out during the great financial crisis, and it was reiterated in 2020 during COVID, and then that was sent out, last summer. Basically stating that you should look at all factors, when it comes to a workout, mostly on cash flow, not necessarily on value, on the loan to value of your asset, when making, accommodations or trying to work through a problem loan. And it kind of runs through a bunch of scenarios that are common, like, oh, well, if you're underwater, maybe consider an A/B note restructure to help facilitate, a proper loan workout for the customer long term.
Yeah,
Let's talk
I
about
agree
those
with
A&B
you.
structures.
I agree
Sorry,
with you,
sorry.
Jason. It's not as if the fundamentals of loan workout have changed.
No, I think it came out just to reinforce to new workout folks that, hey, let's, don't just view the collateral value as the end all be all. If you're underwater, that can just be a temporary issue, given that, interest rates went up and cap rates went up and everything else like that. Look at the underlying fundamentals of the loan and the cash flow to support a restructure.
Yeah, what I'm hearing from a lot of folks is the higher interest rates are making the A/B structures less workable. Bill, any thoughts on the A and B structures, when they work, when they don't work?
I think you hit the nail right on the head. Is that, as interest rates go up, all the dynamics change. It's the problem becomes is that the portion of the workable A note becomes smaller, and now you've got a bigger B note, and instead of being a kind of stub piece, it becomes sometimes a significant piece of the loan, and then the bank's faced with, or any lender's faced with a different choice given the cost to carry the loan to get to the end result, and the interest rate you can charge. So at that point, you're really looking at a different dynamic as an initial lender of, is it best to move this off my books, take a discounted payoff, because the cost to collect the loan in full, given that type of structure and the significant size we're seeing of the up-tiering of B notes, it's just what's the best risk-adjusted net present value return for the bank. And if that's a discounted payoff either via a borrower or a note sale, that may be your best bet given the window you have.
Yeah, you'll probably collect a little bit of that B note today than you would if you just had it sitting on your books at a zero book balance. But yeah, when you get to the point where you've restructured it based on cash flow, and the A note's supposed to be at market terms, because the whole point of the A note is you want to move it back to accrual on this retained customer, and you have this B note, that can maybe get repaid back over time. But if it's to the point where the B note is vastly larger than the A note, it doesn't make sense. I mean, it's just a fact. It's really helpful in those situations where your loan to value is at 110%, and the cash flow went down because they lost some tenants, and you're going to restructure it, and you'll have that A note. The guy's a really good customer, been a long time customer, and you want to keep him, and he'll eventually pay you when he sells a bunch of other stuff. Then that kind of makes sense. But if it's just a standalone relationship, I'd be picking up the phone with John and seeing what the market's going to bear on it.
Thank you, Jason, for that plug. On a basic level, I mean, when do you move a loan to work out? When do we bring you folks into a situation? When's the right time to do it?
Early, John. And that's certainly the key. You're going to have a much better outcome if you can get earlier rather than later.
Yeah, John, I would say half the things I look at I never ever work on.
That's right. That's right.
They could be originations, they could be amendment request. It's just really getting a fresh set of eyes on it and a different perspective. I would say if you reach out to your workout folks, 10% of the time they're going to tell you you're doing everything right. 10% of the time they're going to say you're about to make a big mistake. And the other 80% of the time it's somewhere in between. But it's always good to have a different perspective than a pure credit perspective on something, because you've got a lot of non-monetary factors that are involved there. What's the relationship? Do you have relationships with the principals? Is this a stretch we need to make? Things like that.
And this comes back to the importance of a good working relationship between the line and workout, so that it's a consultative relationship and line lenders aren't afraid to reach out and ask for advice.
But when a loan does move to the workout group, what role does the relationship manager play going forward? And what are some best practices there? I know with some smaller institutions, it's harder sometimes to completely break the chain from relationship lender to workout.
It should be a pretty hard break. You want to keep your line partners involved to make sure they don't have any surprises as things kind of progress in your management of the credit, especially if it's a sensitive issue with a large customer or they're a center of influence in your community. You want to keep them apprised. But like I mentioned earlier, when it's coming into your workout shop, it's very clear that it needs to be once it's workout managed, that workout is the only point of contact for the bank, and they're the only ones that can speak on behalf of the institution, because desperate people can make desperate decisions, and that's going to be, I'm going to call, the bank president because I met him at a networking event and he helped, he was my original loan officer 20 years ago, and I'm just going to go around your head because I don't like the message I'm being delivered right now. So,
and that's why it's important that the communication internally goes on. And as Jason said, the original relationship manager is kind of out of the picture in direct communication with the client, but it's also our responsibility as workout officers to give you a heads up of what we're doing and have what I call the speak now or forever hold your peace conversations internally, so that everybody's on board with what they're doing. And to the extent you get someone who's in a desperate or wants to throw a Hail Mary situation, everybody's informed and they're not reacting to one side of the proverbial one side of the story from the client. And given their historic relationship with them, it just creates more chaos.
Couldn't agree more. At the same time, the original lender, the line lender, can certainly play a constructive role in making sure that the handoff is smooth.
Yeah. We had a good question from Kristen. Can you talk about when you would invoke a default rate? Would you hesitate to do that if you have not called out prior covenant violations? What I am hearing is if you don't resolve it in one reporting period, you either call the default or you're not on solid ground.
No, I think what you do is once you get past the original the reservation of rights letter, the comment was that you just don't want to keep issuing reservation of rights letter. You need to come to a solution, whether it's an amendment or forbearance agreement. You don't have to implement the default rate interest. You don't have to take any action. You can agree to forbear on the defaults for some period of time while you attempt to reach a deal. The comment was directed at avoiding a course of dealing issue, so that if you don't reach a resolution, you're not hampered in your go forward process. But as far as the default rate, that's really a function of what you're trying to accomplish. Are you trying to get the client out of the bank? You're trying to get the client to the table. Once you issue a reservations of rights letter, you have the right to implement the default rate from the date of default.
Yeah.
It doesn't mean you have to, you just have the right to. It's just another arrow in the quiver as to bring people to the table.
And Bill made a great point. Like it's you want to be strategic on when you do enact that rate. I mean, it's a pretty big lever, and it's one that I've had to utilize in middle market workout and commercial workout, because when you're dealing with smaller businesses, they have a tendency sometimes to just ostrich themselves and put their head in the sand. They don't want to address it. They think you'll just go away. And, eventually if you do charge the default rate, they get that first bill, that'll bring them back to the table. And then you can always put as, one of your workout solutions that will credit you back the default rate, right? It's kind of funny money, in some aspect. It's within our rights and remedies, as long as we didn't waive it, because we did waive the covenant 5 times and now we're just going to fire it off. But you can still be deliberate. And, back to Bill's point, if you do have a covenant default, maybe sometimes it's, you do want to just get a reservation, a forbearance agreement, because you want that waiver of claims and defense language in there, because maybe some banker or somebody, gave them a promise and they weren't entitled to do that, or they shouldn't have done that. And you want to get that piece of paper. So, and I would say one other thing for, when it comes to covenants, if the customer can never meet a covenant, then you got to readjust it to something that they can meet, or you need to renegotiate the whole loan because the risk profiles change. If they can't meet that basic covenant when it was underwritten, then you need to figure out, all right, do we have the right structure in place? Do we have the right rate assigned to this? Put something in place that they can meet. But in exchange for that, maybe increase the rate, get a fee, do whatever to offset that risk.
Yeah.
If anybody has, sorry, go ahead, Justin.
Yeah, just to Jason's point, one of the most important things is when you're doing an amendment in a challenge credit is that, both parties grant each other mutual releases. So at that point, once the document's signed, all the sins of the past are gone on both sides. And you really learn about a lot about what the intent of the client is and there's potentially their strategy going forward when they object to that. And the bank doesn't want to give an accommodation when we know we're going to have to go fight a battle from 3 years ago. I'm not required to give the accommodation today. So why would I give the accommodation unless I know where I'm starting from? And I think it's a very important thing that a lot of people don't focus on, but it tells you a lot about where your client's going. The more they object to it, the more you're probably in for a non-consensual resolution.
Yeah, that's 100%. I mean, I won't sign any document that did not have a waiver of claims or mutual releases. It's not negotiable because then if you do have something to fight about, let's fight about it now.
I've got you in default.
Yeah, I mean, let's go. If there's nothing, if you don't have any claims, then why are you going to object to the language? So it's kind of my thing.
Yeah, I couldn't agree.
You don't want to get brought back into a 3-year deal. And I can't tell you how many times in a deposition or in a court case where I just put that waiver of claims and defenses language in some forbearance or modification and prove that they signed it. What are we even talking about at origination? You didn't bring it up then. We told you. You had attorneys that reviewed that document. Sorry.
Justin, you want to say something?
Yeah, no question, guys. Couldn't agree more. Jason, going back to your point about, the fact that you can be creative with default rate interest. In another way that you can be creative is to potentially pick default rate interest.
Yeah, you never want to give up a lever until you reach a final resolution.
That's right.
Yeah,
that's right, Bill. Yep.
Well, speaking about the legal side, and by the way, if anyone has any questions, use the chat function. We're getting some good questions. But from the legal side, how does it change the dynamic when the bar brings counsel? I would imagine sometimes it helps, sometimes it hurts. Thoughts on that when borrowers lawyer up?
I would say it depends on the size of the loan. Sometimes it's almost always appropriate to bring counsel. It also depends on the counsel. I think all of us doing this as long as we had know most every attorney we wind up on the other side of the table with, and we know how they're going to react. And it says a lot about the client of who they engage. If you're going to come into a deal where you've got no options and bring a flamethrower, it's kind of a waste of everybody's time. That being said, there's a lot of times where people just aren't sophisticated enough from a legal standpoint where counsel actually helps the process move forward because
No question.
they don't look, that someone on their side is telling them, yes, it's okay what the bank's doing or asking for.
Yeah,
No question.
I couldn't
Or
agree more.
if you have a hothead, a hothead of a borrower, and an attorney can calm things down and keep everyone on an even keel.
Yeah, I mean,
Yeah.
none of this is personal. Most people who have short fuses or fly off the handle, they're just poor negotiators. And so you can't take it personally. I mean, if I'm not called a jackass 3 times a week, it's a slow week. It just tells me the guy on the other side of the table he has poor negotiating skills. There's no reason to start throwing bombs before you know what I'm asking for.
And there's nothing wrong with them getting counsel. Just when I caution my teams, when, if they say, hey, I'm bringing my attorney to this meeting, that's great. Good. You're well within your rights to do so, but we'll need our own counsel to be there. So never go into a meeting or never discuss, with their counsel one-on-one is kind of my rule of thumb with my bankers. But it can't, yes, Bill's 100% right that there are those debtor firms that that they are itching for a fight, and that's their bread and butter. And you do kind of change your way with them, and I would change sometimes who I'm going to assign counsel to. So it's maybe not more transactional. I'm going to want somebody that has a good litigation practice, because that's where it's going to go.
Well, Jason, obviously you're in Florida. I know you've worked on deals nationwide. On the real estate side, Texas, you can foreclose on a borrower in 60 days. New York could take you 2 to 3 years. Any thoughts on how the state and from a real estate standpoint changes the workout strategy?
Not really. For me, like we mentioned, you want to get the best resolution on a risk-adjusted net present value basis. So you just kind of factor that in. Hey, if this is a deal in New York and this is going to be a 3-year litigation, just put that out in your NPV analysis and go out 3 years, and then put out another, whatever the appraisal is saying as the marketing exposure period. So now you're at 5 years before you can even, get to liquidate this asset. And it just factors in, maybe it's better to do the note sale, or maybe it's, let's get with the borrower, do a discounted payoff, or maybe a restructure, and shorten the time frame and get them to find another lender is the better opportunity, or the better use of your time. But for me, it doesn't change the business decision. If it's, if we have no other recourse and, we can't get to a solution and foreclosure is your only option, and you tell me the reserve on this loan is 20 cents on the dollar, I'm pretty confident even with a 5-year litigation and liquidation period, I could probably beat that. But, it is, you just kind of factor that in. It doesn't change really my overall strategy.
Yeah, I think one thing, Jason, you said that I think we should define is when you say risk adjusted, the risk is 2 sides. The risk is what's the risk from a time and expense standpoint on the bank strategy, and what's the risk with the client from their ability to execute. And you have to take those and put those 2 together, because selling a loan at a discount, while you may get 100 cents on a dollar 5 years from now, what's your cost to carry the loan for 5 years, the expenses you have to put out, and do you really get a better risk-adjusted net present value? Most of the time, the answer is no.
Well, which is why, most of the time, if we know it's a hard exit, there's no exclusionary criteria from preventing us from selling. There's no claims that are outstanding. We can get full disclosure to sell it. If I know it's going to be a litigation, I would rather take the money today, have my, yes, we'll take a loss, but that capital can be redeployed because it's a criticized asset, and if it's going to foreclosure, it's probably non-accrual. So now your loan loss reserve went from, a performing loan, I'm just spitballing numbers, is 2%, criticized is 5%. Non-performing loan can be anywhere, I've seen it anywhere from 10 to 20, depending on the type of collateral that you're trying to foreclose. And if you're at a 20% reserve requirement, loan loss reserve, yeah, I mean, that's 20% every year. That's just dragging on your balance sheet. That's when you need to call, John to, to put this up for sale because yeah. And I've had these discussions all the time with credit officers. Why'd you sell my loan at a 42% loan to value at 70 cents on the dollar? Well, it was in, Fairbanks, Alaska. It was a three-story office building with nothing around it. There's very little market there. The appraisal was probably overstated, and to get that value, it's going to take an inordinate amount of time and capital and expense. And your first loss, as I like to say, is usually your best when it comes to those type of deals.
Let's talk about bankruptcy. When borrowers file bankruptcy, obviously it's going to increase your legal expense, but how can it be a positive and how is it often a negative?
When it comes to bankruptcy, bankruptcy is just simply a business tool. It's not good. It's not bad. Most of the time, most of the bankruptcies on the larger side of loans are done on a consensual basis to facilitate a transaction or a resolution. I think the big loser is when you have a non-consensual bankruptcy, when the parties are fighting. And those tend to happen, believe it or not, on the smaller side of the economy, where people just don't want to accept reality and think bankruptcy is some kind of way to save their business. Most of the time, those bankruptcies wind up failing. The plan may get approved, but they don't succeed. The expense to the estate and the individual is enormous, given the amount of debt that's involved. So it's just a business tool. There's sometimes the only way to facilitate a transaction is through a Chapter 11.
And sometimes with
right.
small bankruptcies, there's a little thing called a personal guarantee on a lot of those loans. So it doesn't really fix the principal's problem with their business, because then fine, you got me on this deal, but I now have you on your personal guarantee, and they'll file bankruptcy too, but it's going to be an inordinate amount of trouble for them, and it's usually doesn't work.
To your point, Bill, certainly bankruptcy can facilitate a deal in many instances. I've certainly had, many positive experiences with respect to a 363 sale outcome ultimately, and just to get the interested parties in a room, and in a process can be very beneficial.
The other thing I don't think people realize is, I'm sure I can speak for Jason and Justin, is if given my choice of state court or bankruptcy court, I'll take bankruptcy court 100%. We know what the rules are. It's a defined timeline and a defined resolution. State court, God knows what can happen there.
That's right. Yeah, because usually, in my experience, the judges in bankruptcy court, they know business. I mean, that's why they're there. They're specialized. They understand that language. Sometimes with state court judges, there's very good ones, and sometimes it's, if you're in a little podunk town, I mean, you're just going to get railroaded. So, no matter the strength of your case, so it is kind of the Wild West in state court sometimes.
Forget about little podunk towns. I've had some very negative experiences in Cook County, Illinois, and Chicago in state court. But anyway,
what? Cook County?
Hey, leave us alone. Best place to do business.
You see my Cubs banner in the background, so
I like it, Chase.
Brian asked, with the adoption of CECL and elimination of TDR definitions, does that change any strategies from a workout perspective?
No.
No. TDRs are just more of an internal accounting pain in the rear than anything.
That's right.
Again, you go back to the best decision on a risk-adjusted net present value basis. And if that's a TDR, it's a TDR. If it's not a TDR, it's not a TDR. But that's really, we don't say this a lot as workout folks, but that's really where our mentality is to get the best recovery for the bank with the least amount of complications. And more moving parts, more risk, and especially when you have a distressed situation. You can get results, and no matter what the result is, good or bad, we're gonna get blamed for the loss.
I never made a business decision in workout and was like, man, I really don't want to do this decision because I'm gonna have to fill out a TDR form. It was a pain, but it was just like, this is still the best decision, and I'll do this little paperwork. And it's just again, it's on your loan servicing system, so it can get reported to your regulators on how you did it, and then you change your loan loss reserves. But with CECL now and the loan loss reserves, I mean, that gets back to our point that you want to factor that in, because if it's a non-accruing credit, you're going to have a much higher loan loss reserve than if it was performing, so.
Yeah. Well, I know, Jason, you're a big proponent of loan sales. I think you've often said in a lot of cases it makes sense. Could you give us a little color on when and when it makes sense?
Yeah. So it's just another tool that you have in order to get a resolution. And I always like to say that note sales used to be the lazy man's workout, because you just call 3 people, or you hire John, or you hire FFN or any of John's competitors, and they're going to go ahead and sell the loan, and you'll be done in 3 to 6 months at the most. And it probably held true maybe in the great financial crisis, when loan sales were getting 50 cents on the dollar, because at that point, then your risk adjusted net present value, depending on what jurisdiction you are, you could probably do better than 50 cents on the dollar with a restructure and better monitoring, bringing the maturity in, changing the interest rate, picking up collateral, whatever. But as the most recent economy has changed, there's been a better, more entrants have come into the market. There's more liquidity, and even some of the larger financial institutions are getting in the game and buying scratch and dent portfolios, which was kind of my sweet spot when I was over at Wells. So, I mean, but from a standpoint and being systemic about doing sales or portfolio sales, it's monitoring your portfolio, having a clear delineation of what we're willing to sell, and having a process in there. What can't we sell? What's a hard no? SBA, financial crimes, single family resident. I mean, whatever the swaps. Anything that can create some issues with that. To the risk. The risk tolerance of your institution, and then making sure that you have a full and complete due diligence package. Because in my experience, the more transparent you are, just like we want it from our borrowers, but the more open that you are to the buyers, the better price and execution you're going to get, because buyers are going to deduct for uncertainty. They're going to heavily deduct for that. Everything else is a bond. It's a mortgage bond problem for them, just like a net present value. I mean, they're just going to take the payments that they think they can get. They're going to discount it back at whatever their cost of capital, and that's the price they're willing to pay. But if you don't have financials, or you're not giving them the appraisal, or they have to make some guesses, that's 5% off. That's 10% off. So, but it's a really good tool, especially in the more recent, time. And as workout officers become more scarce, especially experienced ones, and you have a lot of new officers in, it could be a really good tool if you're getting some pressure from your regulators to shrink your CRE portfolio or something like that relatively quickly.
Well, one thing I would add on loan sales for banks is there's probably a 5-cent difference in price between a bank like Jason's former employer or the FDIC and a bank that does not have a good reputation in the market for selling loans. So if you're going to sell loans, you want a reputation of being a good counterparty, because you will get rewarded for that.
Yep, it's something we took very seriously. So it worked out well.
Bill, Justin, loan sales?
It's been a very effective strategy for me, John. Obviously, you and I have worked on any number of transactions together over the years. Not a universal fit, of course. Nothing is. Sometimes you're better off, engaging in a long-term workout.
Especially if it's a retain, like you got to make that. Going back to our discussion, if you don't want to sell a retain, if you like this guy and it's a or a business, and it was a one-time, they lost a big tenant or they lost a major customer or whatever it is, and their cash flow has been impaired, and it's going to take a year or two, but they've always stand behind their deal. We have all their other services and everything else. you don't want to necessarily go to a sale right away with that, unless you get air cover from the rest of your team. But if it's an exit, it's a standalone relationship, one CRE deal that we got queued on because we were trying to win the rest of the business, the line doesn't have a lot of energy around it, then consider it as another tool.
Someone asked a question. What is your approach? This is for you, Bill. What is your approach to existing or unknown environmental issues? How does it impact potential loan sales or other strategies?
Well, I mean, I think at the end of the day, you've got to get all the variables hammered out. And so if they're unknown, you've got to go through the process. If not, the party you're selling to, just like lack of financials. I mean, if you have a high risk property, it's, and you're not able to provide the buyer with, or the bank with the right data to support that it falls in or out of that category, everybody's going to assume it's in.
Yeah.
I mean, we have sold environmentally challenging assets, but we have a complete history of all the phase 1s, phase 2s, the remediation that's done. You got to document that. And if you don't have that, you're better off pausing what you're doing. Getting back to our point earlier, working with your customer to get access and do what you can to get them to remediate as much as they can and they can afford, and fix those issues before you go to market with it. Because the last thing you want to do is sell a loan. One, the buyers, if they think there's any environmental issue, are going to hammer it on price. 20, 40, 50% off right away. And then 2, if we knew about some environmental damages and we didn't disclose it because we didn't get a complete loan file or something, guess who's going to probably sue when they do their own phase? It's going to be the bank, and you're back into this deal that you thought you were out of. So be very cautious on how you do it and have the right language in there. But if there's any hint that there's a contamination, I would say you got to address that first before you sell. Or especially before you even take title too,
You got to be able to define it.
Yeah.
At a minimum.
Last question. War stories. Tell us why sometimes things go bad in a workout.
Yeah, that could be another couple hours.
Could be another couple hours. Yeah.
Yeah. I mean, I think the reason things go bad is, my world being larger syndicated credits, you have a combination of unrealistic lenders for the outcome and a combination of sponsors who think you're their quote unquote partners and want you to fix their problem for you. It leads, you could have I've had poor underwriting where people underwrote one thing and didn't realize what the business was. The level of write-offs when you have to go in there and say, oh, by the way, we just lost, I think the last deal I did, we lost 85 cents on the dollar on something we did 6 months earlier. It was an originated loan, lost 85 cents on the dollar in 6 months. And people are asking me why. I'm like, I'm just trying to get through this. But, when you have acquisitions, and most of my transactions are a function of mergers and acquisitions, the level of over-optimistic synergies that exist from combining businesses are just, can create nightmares beyond nightmares.
Bill, I was going to say something similar, having had a lot of experience working out large syndicated credits as agent myself. Dysfunctional bank groups, I would put that at the top as well.
Yeah.
Yeah. In commercial banking, it gets back to the reasons that you have a loan loss, that I've started the presentation with today. Any of the 5 C's of credit that weren't done. My favorite horror story was a pet cemetery that I had, and the bank didn't know about it until I did my property inspection. And that changed my entire strategy, and we ended up getting out of it and not having to take the pet cemetery back and preserve our collateral and the drainage issues. But that one you couldn't make up. Like that was the spookiest property inspection I've ever been on in my life. So
sounds like a movie.
It was, yeah.
Yeah, what I would say is that, we could go on with horror stories and war stories forever, but they represent a very small portion of what we do. They're all true. We don't make this stuff up, as crazy as some of this sounds, but 90% of the time, there's always a deal to be had. And when the 10% that's not, I can't speak for Justin and Jason, but I know I kick myself going, why couldn't I get to a deal? It's so obvious that it's a better resolution for everybody.
Well,
and sometimes you just get a situation where people think they're wronged. And no matter what you do, no matter how much you give them, they're going down with the ship.
And Bill, sometimes you're dealing with people of questionable character. And those are the situations, where I've had the most difficulty.
Always. I tell my line partners all the time, any of the other 5C or any of the other 4Cs of credit, I can usually fix. It's the character one. There's no fixing that one. Yeah. You can't fix it. And that's where, the John Morgan quote when he testified in front of Congress in 1913, that character above all else is the one thing that he, would base his lending decision on. And it holds true today.
So true. Well, this has been a terrific discussion. We've had a wonderful discussion. Bob, you want to sign us off?
I would love to, gentlemen. That was awesome. I do have one question. A lot of my audience are SBA lenders. Do any of you have any experience with SBA workouts and any good tips for our people who are listening with that specialty?
No.
Follow the SBA regulations to a T if you want to preserve your guarantee.
Fair enough.
That's all that matters, is preserving that guarantee, and make sure you have really good internal counsel that knows the SBA world, that you follow that by the book, because you just don't want to impair that. And I don't. It's really challenging to sell. I mean, we never sold SBA at Wells, but yeah, just got to follow that very closely. And if it's a 504, make sure you understand, the CDC that's behind you, and making sure that you give them the right opportunities and notifications and stuff. That's all I got.
That's perfect. Thanks, Jason. Very good. John, well, very good. And this was an excellent presentation. If you want to review it, it is on YouTube. It'll be up there. And with that, this concludes today's webinar. Thank you very much.
Thank you, everyone. Have a great day.
Thanks.